All right, let's go back to what we were talking about just a few moments ago and dig deeper into what is fueling the rally and why investors, for now, seem to be putting aside all the risk. Let's bring in Chris Zaccarelli, Chief Investment Officer with the Independent Advisor Alliance, and Ernie Cecilia, Chief Investment Officer with Bryn Mawr Trust. Mr. Zaccarelli, let me begin with you, because in my note it says that the market is pretty complacent with the risks of an escalating and prolonged trade war with China. Why do you think that is?
Well, I think you've touched on a lot of the topics already in the beginning of the discussion. I think the fact that the tariffs came in at 10% instead of 25% was viewed positively by the market, and you're seeing the market rally on that. I think the market's being a little complacent because I think a lot of the actions that have taken place so far, both words and actions by China, show that they're digging in for the long haul. They're lowering tariffs on all the rest of their trading partners. They're easing credit, whereas before they were tightening credit. I think they're really digging their heels in. I think this may go on for longer than people expect. So that's why I think we're being complacent. And I think that actually dovetails nicely into the idea that the big risk is that the rest of the world goes into a further slowdown. I think the tariffs going into full effect, let's say next year, and lasting for longer than people expect, that can be a real risk to the market globally, which will then come back to the U.S. as well. That's why I feel like we're being a little complacent.
The end result, you say, is an ever-growing threat to the world economy and to markets that may be ignored until it is too late. That suggests that it is time to move out of equities, or at least de-risk my portfolio. Is that what you're proposing here, Chris? And then I'll get to you, Ernie.
I'm definitely not saying that you need to go to cash, that you need to do something radical, but I do think you need to be more concerned about where we are. I think as markets continue to move higher, you definitely want to be a little bit more cautious. I'd buy more quality companies. I'd make sure that the portfolio that you have is one that you would hold through a correction. I'd be really wary of a lot of the momentum stocks and things that are really taking off right now. Those may be stocks you're going to regret having later when and if this correction does come.
Right now, at this moment in time, we're about 27 basis points, the spread between 2s and 10s. With one Fed rate hike, we could be practically there. With two Fed rate hikes by the end of the year, we could be inverted. Should investors prepare their portfolio for the eventuality of potentially a recession now?
Well, two things. One is I absolutely think an inversion of the yield curve is an ominous signal, and if that were to happen, you definitely need to prepare for potentially a recession coming soon after that. What I would say is I don't really look at the 2-10 spread when looking at the yield curve. I like more the 3-month 10-year spread, so that's what a lot of Fed watchers will look at as opposed to a lot of market participants, and I think that's been a better indicator of when an inverted yield curve will lead to a recession. I think if you look at the 2-10s, it doesn't always predict a recession. I think it predicted probably 10 of the last 7 recessions, if you know what I mean, in terms of 3 false positives. So it depends on which yield curve you look at, and I don't think we're there yet on the 3-month to 10-year. But to your point, we absolutely are a lot closer on the 2-10-year spread.
All right, Chris Zaccarelli, Ernie Cecilia, thank you very much.